Like and subscribe to my channel and click the bell icon to get new video updates.
What are crypto wallets? Unlike traditional securities, which are typically bought, sold and held through a brokerage house, cryptocurrencies allow investors to fully manage and transfer their wealth peer-to-peer. For some, one of the main draws of the digital asset ecosystem is opportunity to hold assets without the need for intermediaries like banks and brokers. Unfortunately, this means losing your crypto if you lose the seed phrase or private key for the wallet your tokens are in, which are passwords for online investment accounts equates. In the world of self-custodial cryptocurrency wallets, there is no email recovery or customer support. Fortunately, there is a wide range of wallet options, ranging from fully self-managed to fully outsourced. Digital asset holders should consider what for their personal situation the best is. With options like cold storage, your personal security practices can matter a lot. For the extremely risk-averse, there are ways to get exposure to cryptocurrencies through traditional financial markets that offer third-party custody, usually through a broker. These include futures contracts and exchange-traded funds that invest in them, over-the-counter trusts and publicly traded companies with crypto holdings or a specific business strategy in the industry, including MicroStrategy, an enterprise software company that continues to buy Bitcoin, money transfer specialist Square, and miners Riot Blockchain and Marathon Digital. For those who choose to keep their digital assets outside of the traditional financial arena, deciding what type of wallet to use is a must. The main options are imprisonment versus non-imprisonment and hot versus cold. Users must then select a specific wallet from these choices. Each option offers trade-offs between ownership, usability, and security. Custodial wallets are those held by someone on your behalf. If you store assets on centralized exchanges like Coinbase, Kraken, or Gemini, you must use a custody wallet. Depot wallets are by far the most convenient, as accessing your crypto is the same as a login experience for an online broker. Custodial wallets may suit the average crypto investor whose digital assets make up a small percentage of an overall portfolio. The biggest risk for custodian wallets are stock market hacks and bankruptcy of the custodian. Sophisticated exchanges typically keep most of their coins in cold storage, have multifaceted authentication measures, and use complex firewalls. However, this does not mean that they are immune to attacks. In 2019, hackers stole $40 million worth of Bitcoin in an orchestrated attack, using phishing scams and viruses, against the popular Binance exchange. Additionally, as with centralized funding platforms and exchanges like Celsius, Voyager, and FTX, these institutions can freeze accounts and withdrawals when they face liquidity issues. Relying on third parties is easy, but it comes with its own set of risks. This category comes in two temperatures: hot and cold. Hot wallets are those that require an internet connection to access. They can be in desktop, web or mobile form. Cold wallets do not rely on the internet. Cold wallets are physical devices that are nearly impossible to compromise as they are not connected to the internet. Hot wallets are sometimes referred to as software wallets. Desktop wallets store a user's private keys on the computer's hard drive. Desktop wallets are relatively easy to use. Examples are Exodus Wallet and Atomic Wallet for multiple digital assets, or Electrum and Bitcoin Core, specifically for the Bitcoin network. Unfortunately, desktop wallets can be vulnerable to malware. A trend with non-custodial wallets is that your assets are as secure as your individual security practices, and people fall victim to phishing scams fairly regularly. Between 2019 and 2020, hackers stole over $22 million worth of Bitcoin from Electrum wallets, sending users fake messages urging them to update their software. Coinbase also offers a version for users who prefer self-custody. These wallets do not store any private keys or personal information. They also allow users to sign transactions and interact with blockchain protocols. Additionally, many popular decentralized applications have built integrations with these wallets to make it easier for users to access their crypto holdings when using them. For these reasons, they are the most popular type of non-custodial wallet. Like desktop wallets, they can also be subject to phishing scams and malware. Storing your digital assets offline starts with choosing a hardware wallet. The most popular manufacturers are Ledger and Trezor. While nefarious actors have been known to attempt to steal crypto by manipulating hardware wallet devices, sometimes by compromising their supply chains, offline storage is by far the most secure as no internet connection is required.